Ladies and gentlemen, thank you for standing by, and welcome to the Niu Technologies first quarter 2021 earnings conference call. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session, and instructions will follow at that time. As a reminder, we are recording today's call. If you have any objections, you may disconnect at this time. Now, I will turn the call over to Mr. Jason Yang, Investor Relations Manager of Niu Technologies. Mr. Yang, please go ahead.
Thank you, operator. Hello, everyone. Welcome to today's conference call to discuss Niu Technologies results for the first quarter 2021. The earnings press release, corporate presentation, and financial spreadsheets have been posted on the Niu Investor Relations website. This call is being webcast from company's IR website, and the replay of the call will be available soon. Please note today's discussion will contain forward-looking statements made under the safe harbor provisions of the United States Private Securities Litigation Reform Act of 1995. Forward-looking statements involve risks, uncertainties, assumptions, and other factors. The company's actual results may be materially different from those expressed today. Further information regarding the risk factors is included in the company's public filings with the Securities and Exchange Commission. The company does not assume any obligation to update any forward-looking statements except as required by law. Our earnings press release and this call include discussions of certain non-GAAP financial measures. The press release contains a definition of non-GAAP financial measures and reconciliation of GAAP to non-GAAP financial results. On the call with me today are our CEO, Dr. Yan Li, and the CFO, Mr. Hardy Zhang. Now let me turn the call over to Yan.
Thanks, Jason, and thanks everyone for joining us on the call today. So in Q1, we saw a 322% year-over-year jump in China sales. We shipped nearly 145,000 units in China, propelled by an aggressive expansion of our retail footprint and a multi-channel marketing campaign nicknamed the Year of Niu. Additionally, our overseas market saw shipments of 5,000 units for the first quarter. The small decline of 15% in the overseas market was primarily due to the orders that could not be shipped out, resulting from the ongoing global shipping bottlenecks you are all aware of. The total Q1 sales for China and the international market were up 273% year-over-year. In Q1, not even the Chinese New Year holiday could slow down our retail expansion. We added 300 new branded stores across China, reaching 1,916 stores by March 31st. During our global product launch event on April 6th, we announced the opening of our 2,000th store in China. We're well on track to hit our Q2 target of 300 new stores for the quarter. For the international market, even under the restraint of COVID-19, we managed to add an additional 7 flagship and premium stores, which now total 123 across Europe, the Americas, and Southeast Asia. This is in addition to the 1,000 plus authorized new dealers in our global markets. For those of you who didn't already know, our company name, Niu, actually means bull or ox in English. The year of 2021 happens to be the year of ox in the Chinese lunar calendar. So we kick off the Chinese New Year by launching the Year of Niu, Be a Newer nationwide campaign. We enlisted the help of popular musicians and social media influencers, which generated more than 200 million views across multiple social media platforms during the holiday season. We also kicked off an over-the-air advertisement campaign during the Chinese New Year, which allowed us targeting over 110 million viewers across markets in China that we have identified as key to helping us accelerate our growth. We also collaborated with one of the hottest online documentary series called Exotic Food on Bilibili, which helped us targeting another 41 million viewers in the key demographic segments. Our new branded Douyin and Kuaishou accounts also benefit from those activities, with quarterly views reaching nearly 55 million views in Q1, marking a 38% year-over-year increase. Now, in the overseas markets, our social media channels gained nearly 1 million interactions on Instagram and Facebook. We also announced our partnership with Formula E World Champion Antonio Felix da Costa as the official new ambassador, and the kickoff of our partnership is line in the key US and European market, which will help accelerate adoption of electric two-wheelers. We have been making noise both in the China and overseas market in order to position ourselves as the go-to lifestyle brand for urban mobility and helping us grow sales by more than 300% in China alone. Now, riding our strong sales and marketing performance in Q1, we hit the ground running on April 6th with our global product launch, simultaneously announcing both China and international product releases. Building upon the customer demand for our GOVA series of electric mopeds, we launched the GOVA F series with F0, F2, and F4, and the GOVA C series with the C0. These are two key product groups that will help us expanding into the wider range of urban markets and the customer segments around China. During that same event, we launched our first electric kick scooter for Europe and the United States, the KQi series. These 5 new products were also accompanied by 4 upgrades to our existing series of mopeds and electric bicycles. First, all of the upgrades to the existing electric bicycle mopeds are made under the hood. First, we're very excited to launch the 7th generation of our new energy system, which saw an upgrade of our proprietary battery management system, the introduction of VTEC electric motor, and the optimization of our FOC algorithm for the motor controller, which can improve the driving range by up to 32% and improve acceleration by 10 to 15% under the same motor power in most of our existing vehicles. And lastly, as we finalize commercialized version of our urban motorcycle, the RQi, we have made great stride of our mid-mountain motor that can reach speed of 160 km/h. As for our product upgrade, let's start with the brand new MQi2S, an upgrade of 2020 MQi2, which should serve as our flagship product under the new China national standard for electric bicycles. The new M2S is equipped with our latest smart IoT technologies, a color display with navigation that can mirror your mobile phone, the OkGo system with distance sensing and keyless ignition, which enable users to start a bike as soon as they sit on the seat. It's those small user experience touches that our customers really appreciate. The M2S is expected to be priced at up to 8,000 RMB, and we also upgrade our classic UQi series with the all-new color display, a new handlebar design with more intuitive control functions, and most importantly, we have given customers the option to upgrade to a larger battery, which increases the driving range by 35% or up to 75 kilometers on a single charge on a new UQi. The upgrade UQi series is expected to be priced at up to 6,000 RMB. For the new product, we launched 2 new GOVA series, the GOVA F and the GOVA C series. Those 2 new series employ an all-new design language for the electric bicycles in China, which will further expand our offerings for the mid-end product lines, which help us to reach a wider range of customers' tastes. Inside the GOVA F series, we announced 3 new models, the F0, F2, and F4. F0 and F2 are classified as electric bicycles in China and were introduced into the market on April 6th and May 17th respectively. The F4 is the electric motorcycle and will be introduced later this year in Q3. The entire GOVA F series has a masculine design style which features the eagle eye headlights. All of those models are lithium-ion battery based. The F0 has 2 versions, primarily differentiated by the battery and drive range of 50 and 60 kilometers respectively, affordably priced at RMB 2,899 and 3,299 respectively. We believe those will be well received by the market. Our beliefs were confirmed when we launched the GOVA F0 through the JD.com pre-sales on April 6th, where we sold 41,000 units and surpassed more than RMB 100 million in sales, setting the JD.com pre-sale record for urban mobility products. The F2 has 2 versions, 50 km and 70 km range options, priced at RMB 3,699 and 4,099 RMB. The F4 has 3 versions with drive range up to 100 kilometers and expected to be priced at up to 7,000 RMB. Now, under the GOVA C series, we have first announced the C0, an electric bicycle with a more feminine design style. The GOVA C0 comes with multiple Macron dessert flavored color choices and a wide variety of accessories, including a child seat, enable mothers to ride safely to take their children to and from school every day. The GOVA C0 also has two versions, with a drive range from 50 to 60 kilometers, and expected to be priced around 3,000 RMB. Since first announcing the C0 in April, we have received countless solicitations both online and in our stores around the country. We expect to release the C0 for sales starting in June. Now, the GOVA S-Series and C-Series significantly expand our GOVA product line portfolios. The successful pre-sale campaign for the F0 is a direct evidence that there is a large group of consumers who appreciate the design style and aesthetics. Together with the G series, the three GOVA lines will offer our customers a thoroughly designed product that meets their taste and desires while being competitively priced and backed by our best-in-class technologies. Now, last but not least, we launched a completely new category in the new ecosystem of products with our KQi kick scooter. The urban mobility trends are changing around the world as customers adopt new models of safe transport and the cities begin to reshape their urban centers. Our electric moped and motorcycles offer one type of mobility solution for customers in cities across Europe, the Americas, and Southeast Asia. We also recognize a rapid growth in user demand for micro-mobility products that cater to shorter 1 to 5 kilometer trips. And this is primarily being fueled by electric kick scooters in both sharing and consumer-owned form factors. Now, in order to meet this demand and add to our product lines, we have rapidly developed a team of seasoned engineers who are specialized in the development and the manufacturing of micro-mobility products. The all-new KQi3 kick scooter will be the first of several models we'll release in the coming months for the key overseas market. Now, equipped with the best-in-class 350 watts rear hub motor and powered by our 48-volt new energy system, and with a wider and safer platform decks and handlebar architecture and wider tires, the KQi3 will outperform many of the similar priced products in the market in both performance and the riding stability. And of course, like all our products, the KQi3 is app connected. The KQi3 has a Pro and Sports version and will be priced from $599 in the United States and €599 in Europe. An online pre-sale will begin in the coming weeks with deliveries directly to the customer homes later this summer in Europe and the United States. Now, in addition to our current 1,000-plus authorized new dealers, the introduction of a kick scooter will also allow us to open new range of retail channels that were previously not ideal for our electric moped, including big box retail and electronic chains like Best Buy, MediaMarkt, micro-mobility retailers, and online platforms like Amazon. Now, I want to wrap up with a short comments about ramping up our manufacturing capacity. For those of you who have been following along for the past few quarters, you know we have planned to increase our manufacturing capacity by an additional 1 million units per year when we complete the phase 2 of our Changzhou factory. We expect the phase 2 to be completed by early Q3, which will bring our total annual designed capacity to 2 million units, easily supporting the projected growth in the quarters ahead. Now with this, let me turn to Hardy to talk about financials.
Thank you, Yan, and hello everyone. Our press release contains all the figures and comparisons you need. We have also uploaded Excel format figures to our IR website for easy reference. As I review our financial performance, we are referring to the first quarter figures unless I say otherwise, and that all monetary figures are RMB unless otherwise noted. Our Q1 sales volume reached 150,000 units, representing a 273% year-over-year growth. China sales volume increased by 322% as a result of retail sales network expansion and effective branding activities.
International sales volume, however, declined by 15% due to COVID-19, especially the recent lockdowns in Europe and a more challenging environment for international shipping. In March, the Suez Canal was blocked for a week and many ships were delayed or cancelled. We were not able to deliver our products on time. The situation has improved gradually since April, and we are catching up on the delivery. With regards to product mix, N-Series accounted for 9% of total sales volume, partially due to the lower international sales. M-Series accounted for 13%. U-Series accounted for 21%, and GOVA series accounted for 57%. Out of the 57% from GOVA series, 38% was from the mid-end product G0 model, and 14% was from G2 model. In China, the COVID-19 rebounded in Q1, which helped to accelerate the adoption of electric bicycles because many people pay more attention to social distancing and try to avoid public transportation. GOVA series was a very popular choice for many new customers, considering its attractive retail price. This is the key reason for GOVA series taking a larger proportion of sales in Q1. Total revenues increased by 135% to 547 million, above the guidance we provided earlier, mainly due to the higher China sales volume and stronger sales in accessory and spare parts. The revenues from accessories, spare parts, and services reached 102 million, representing a 118% year-over-year growth. The strong sales came from both China and the international market. Sales from China market increased by 111% due to strong offline sales, and the international market increased by 123% due to strong sales of battery packs to sharing operators. The ASP declined by 37% year-over-year. Let's look at the detailed reasons. For China market, the scooter ASP decreased by 27%, mainly due to the sales of low price G0 and G2 models, as well as sales discount offered. Out of this 27% decline, around 20% was caused by the sales of these two models. The remaining 7% was due to the change in other product mix. For international market, the scooter ASP decreased by 15%. The decrease was caused by depreciation of US dollar, and also, more significantly, the change in the way distributor place orders. In Q1, many distributors chose to place separate orders for scooter body and the battery pack so as to reduce their international shipping cost. As a result of such separate orders, battery pack sales were booked as the accessory and the spare parts revenue instead of scooter revenue. After we normalize this impact, the ASP for international sales only decreased by around 5%. Or in other words, out of the total 15% ASP decline for international sales, around 10% was caused by the way of separate orders, and around 5% was caused by depreciation of US dollar. This way of separate ordering will likely continue into Q2 and Q3, considering the increasing cost for international shipping. For the ASP of accessories, spare parts, and services, it was RMB 682 per scooter, a 42% decrease compared with Q1 last year. The decline was mainly due to the very low volume base in Q1 last year, which was only around 40,000 units. Because of the very low volume base, the ASP for accessories, spare parts, and services was abnormally high last year. If you compare the ASP with Q2, Q3, and Q4 last year, our Q1 ASP actually increased. Our revenues from accessories, spare parts, and services do not fluctuate as much as the sales volume because a portion of the sales came from existing customers. For example, the data service and some accessories. In summary, even though our ASP was down by 37%, after considering the factors mentioned above, the international scooter ASP, the accessories, spare parts, and service ASP were both stable compared with early quarters. The decline of China ASP followed a similar trend as what we saw in Q3 and Q4 last year due to the launch of GOVA series. In April, we launched the F0 model and the sales price for F0 model was RMB 200 higher than G0. We also expect the product mix in China to improve in the second quarter. Both will help to stabilize our China scooter ASP. Gross margin was 23.8%, 0.2 percentage points higher than this time last year. There are three key drivers. First, the sales of low-margin models like G0 and G2 reduced our margin by around 4%. Second, the lower proportion of revenue from high-margin international sales reduced our margin by around 3%. Third, the cost savings on components, raw materials, and lower other costs, for example, manufacture and labor costs, benefited from economy of scale, increased our margin by around 7%. In summary, the impact from unfavorable change in product mix was offset by various cost savings. This is the key reason for a stable margin in Q1. In the past few months, we have seen the commodity price continue to rise, which affected our raw material procurement costs by 5 to 10%. To mitigate the impact on gross margin, we increased retail sales price by RMB 100 to 300, or 1.5% to 7.5% for selected models in China in May. We may have another price increase for additional models together with performance upgrade in the coming months. We believe the price increase are affordable and reasonable for our customers. This price adjustment will help us to stabilize the ASP and also to mitigate the negative impact on our gross margin. Our total operating expenses, excluding share-based compensation, were RMB 118 million, increased by 35 million or 42% year-over-year. The increase was mainly caused by the higher sales and marketing expense of 20 million for branding activities during Chinese New Year, 4 million for retail sales network expansion, 8 million for higher staff cost, and around 6 million for foreign exchange loss. Our sales and marketing expenses were particularly high this quarter, mainly due to the branding expenditures associated with the Chinese New Year event mentioned earlier. As a percentage of revenues, our operating expenses, excluding share-based compensation, was 22%, lower than the 36% in Q1 last year, but higher than other quarters in 2020. In the coming quarters, we expect the operating expense as a percentage of revenue will fall back to the regular level similar to early quarters. Our government grant was 0.4 million in Q1, decreased by 7 million compared with last year due to the delayed payment from governments. In May, we received a grant of RMB 41 million, and a part of that will be booked into the P&L in the second quarter. Our income tax expense was 9 million, much higher than the same period last year, mainly because some entities within the group become profitable and have used up the accumulated loss. This quarter, even though our consolidated profit before tax was only around 4 million, we booked some 9 million tax expenses for a few reasons. First, some expenses are not tax deductible. For example, share-based compensation. You need to add that back before calculating income tax expense. Secondly, the profit and loss were not evenly distributed among different entities, companies within the group, because we need to pay tax based on each company instead of as a group. For example, in Q1, the company for China sales was very profitable, but the company for international sales make a big loss. We have intra-group transfer pricing arrangements to redistribute profit, but that will take time to adjust. If you take a longer-term view, the profit will be more evenly distributed and the impact will be mitigated. Thirdly, tax rate applied is the average tax rate calculated based on full-year forecast instead of one specific quarter. For this year, we expect the average tax rate will be around 15% on full-year basis. Our GAAP net loss was 5.4 million RMB, but after adjustment of share-based compensation, we made a profit of 6.7 million, improved by more than 25 million compared with Q1 last year. We made a GAAP loss this quarter mainly due to the higher branding expenses. We believe the branding expenditures are more investment in nature, worthwhile spending. It increased our brand awareness and will support our continued growth. Turning to our balance sheet and cash flow, we ended the quarter with RMB 1 billion cash, term deposit, and short-term investment. Our operating cash flow was negative 16 million RMB, mainly due to prepayment for raw materials in order to secure supply for production. Our Q1 capex was around 64 million, mainly related to capacity expansion of 13 million, new store building of 48 million, and R&D spending of 3 million. Now, let's turn to guidance. We expect second quarter revenues to be in the range of 900 million to 1,030 million, an increase of 40% to 60% year-over-year. With that, let's now open the call for any question that you may have for us. Operator, please go ahead.
Certainly, sir. Ladies and gentlemen, we will now begin the question and answer session. If you wish to ask a question, please press star 1 on your telephone keypad and wait for your name to be announced. Once again, it is star followed by 1 to ask a question. We have the first question. This is coming from the line of Alex Potter from Piper Sandler. Please go ahead.
Hi, guys. Thanks very much. So I guess the first question I have is just on gross margin in the coming quarters. There's really a lot of moving parts right now. There's new products that are coming in at different price points. There's raw material inflation. There's this battery shipment issue, which all kinds of different things. Some are positives, some are negatives. Last quarter, I think you had said that you expected gross margin for this year to be roughly similar to what it was last year. Do you still feel that way, or are you reassessing after viewing some of these new changes?
Thanks, Alex, for the question. For us, we still want to maintain a similar margin as what we delivered last year. That's why in May, we increased our retail sales price by 1.5% to 7.5%. And we may make another price adjustment in later months, and based on how the raw material inflation goes, also based on the pace of new product launch. For the second quarter, of course, our margin will be a little bit challenging because we began to see the price increase since April, but we increased the retail sales price only from early May. So there's 1 month lagging for the price increase. For the second quarter, currently we estimate our gross margin will be anywhere between 20% to 22%. But in Q3, Q4, we still want to target around 22 to 23%. And the thing within our hand is price increase. And also we will also renegotiate some of the costs with our suppliers, try to secure additional cost savings. So this is the answer to your first question, Alex.
Okay, great. That's super helpful. So then maybe a little bit more on the cost pressure, the inflation. I know obviously inflation is a topic that a lot of people are thinking about right now. What specifically is it within your supply chain? Is it primarily batteries, or is it basically across the board price inflation of all kinds of components and raw materials?
It's across the board. It's because our components also involve steel, plastics, and also battery cells. Most of the raw material we see the price increases. It's very much linked with overall commodity price increase.
Right. So I think basically in the last few months or so, we're actually seeing this price increase starting in later March, and then it actually hit us March and April. And we started seeing that some of the raw material price actually hit the peak in early May. So we actually increased our product price to reflect the latest update in terms of the bump price. So going forward, I mean, hopefully we'll see the raw material price will stabilize and actually potentially could start to decrease.
Okay, great. I'm interested also on this topic of splitting apart battery shipments versus the scooter shipments. Is this a tariff issue? How exactly do international importers save money by taking delivery of the battery pack separately from the scooter body?
Yeah, the reason is these days because of the shortage of containers, the international shipping companies become more strict on the cargo can be shipped. For the battery pack, because we have lithium battery within that, it was treated as dangerous cargo. Therefore, the shipping companies charge much higher tariff for anything which has a lithium battery within it. If we separate the order between the battery pack and the body part can still be treated as a regular cargo, where the shipping tariff is much lower than the dangerous cargo. So the difference is more on whether it's dangerous cargo or it's regular cargo. That's the key reason besides the different tariff. The different tariff is mainly in the U.S. In the U.S., there's different tariff on battery pack and the body part. But because of the shortage of the containers, shipping company becomes very, very strict on what kind of thing are within the container. Therefore, they check all the things. Therefore, many distributors try to put them separately to enjoy lower tariff for the regular cargo. So that's the background.
Interesting. Okay, very good. Thanks. I appreciate it. I'll pass it on.
We have the next question. This is coming from the line of Vincent Yu from Needham & Company. Please go ahead.
Thank you, management, for taking my question. I have 3 questions. First one is, we had a very good, strong delivery number for first quarter, and the strong and the store opening pace also seems to be on track. My question is, how should we think about the previously guided to sell more than 1 million units for 2020? Is there a higher annual number that we are comfortable that we would be able to hit after the strong quarter? My second question is in ride-sharing platform for our international business. So we have seen continued investments made by ride-sharing platforms into the e-scooter riding share markets. And can management talk a little bit more about what should we think about challenges and the opportunities that such trend brings for Niu? And my last question is that for the new energy vehicle industry have been seeing a chip shortage. We know we have less demand for some chips, but we also have I know we have quite some chips associated for our app. What kind of effects we have on our products in terms of margin or production schedule, if there's any? Thank you.
Sure. Let me give the first cut of the answer for the 3 questions, and then we'll ask again to supplement. First, for the store opening, definitely we are on track to achieve our target. We have opened 300 in Q1. We are going to open at least another 300 in the second quarter. With the more opening, definitely we do see the volume continue to grow. And definitely in Q1 in March we gave a guidance of 900,000 unit volume to 1.1 million unit. We do see potential upside for the volume growth, but I think we'll wait till the end of Q2 before we make another adjustment for our full year forecast. So this is more on your first question. For the second question about the ride-sharing business, we are mainly supporting ride-sharing business in the international market, and we do see the demand continue to go very, very strong. Because during COVID, we do see people pay more attention to social distancing, and there is also fast adoption of electric two-wheelers in the overseas market. Some of our sharing operator already started to deploy our vehicles in many cities across the world, and that is very positive for our business growth in both the second quarter, also in the quarters ahead. And that is, we believe that's not only a short-term momentum, that maybe change the people's behavior in the longer term, that give our further upside in the even longer term. For the third question about the chip shortage, first of all, we do see the threat for chip shortage. However, compared with the EV manufacturer, the chips we use in our scooters are less complicated compared with the EV manufacturer. Therefore, we are able to secure a majority of the things we want to get. Currently, we need to give a 3 to 6 months rolling forecast to our suppliers. Sometimes we also need to make a small prepayment to secure the supply. Therefore, we do see the challenges, but so far we have some action we can take to mitigate the impact. So I believe the other comments are yes.
I think that captured it. I think the only thing to add is basically when we initially announced about 1 million plus units, I think that's only talking about scooters and mopeds. So it hasn't really covered our new products like the kick scooters. Obviously, the kick scooters will be, we already announced it will be on pre-sales in the next month or so, and then will be shipped basically in early Q3. So that will actually start to adding volumes in addition to the 1 million units of the moped scooters.
Got it. Thank you very much.
Thank you. We have the next question. This is coming from the line of Jing Chang from CICC. Please go ahead.
Hi, thanks for Yan, Hardy, and Jason for your interpretation of first quarter results. So I have two questions. The first is about the expense. So the selling expense in first quarter increased a lot, we can see. Hardy has just explained that we adopt more price discount and also other marketing activities. So I want to know that is it caused by the more fierce competition or just due to our subjective view how to see the trends in the future? And also my question is the second question that we can see the number of stores increased by 300 in the first quarter, so maintaining rapid growth. What is the regional distribution of new stores? Can we see an obvious trend of more stores opening in lower tier cities? And with also our new products, F and C series, targeting more on mass medium market. So what is the proper price range we can expect in the future? These two questions. Thank you.
Sure. Thanks, Jing, for the question. Let me answer the first one about the expenses. The sales and marketing expenses, the very high amount, it was mainly due to the branding activities we made during the Chinese New Year. Because this year, Lunar Chinese New Year is the year of ox, or in China we call it Niu. Because of that, we spent quite some money for the branding purpose. We also engaged a very popular singer who take a video and help us to spread the news brand. So it's mainly for the branding purpose instead of for pure marketing purpose. Because Chinese New Year is kind of one-off event for during Q1. Therefore, we do not expect the sales marketing expense to continue to be very high percentage of revenue. We do believe the percentage will fall back to the normal level. That's what we see in other quarters. So this is answer to your first question. For the second question on the store distribution, I will ask Yan to comment on that.
Right. So I think just quickly to comment on the stores, it tilts towards more tilts towards the lower tier cities, basically tier 2, tier 3, and some of the tier 4 cities as supposed to be initially the tier 1 cities. I think this is partially driven, the fast store expansion is really driven by our suitable products for lower tier cities. Basically the 3 series, the GOVA series, the GOVA G series, and the GOVA S series coming in April, and I think, and hopefully also the GOVA C series coming in June and July. So we're starting seeing the Q4, we start seeing that phenomenon where with the suitable products, and we have a strong brand recognition and brand name in the lower tier cities. But in the past, we just don't have a suitable product for those cities to open more stores. And we actually expect the store opening speed is basically, we hopefully to maintain a constant speed of at least 300 stores-ish per quarter.
Yeah, got it. So what is maybe proper price range or average selling price we can expect in the future? Maybe 3,500 RMB to 4,000 RMB this week.
Yeah, you mean the blended ASP for the coming quarters? I think it will be similar to what we achieved. Yeah, I think it will be similar to what we achieved in Q3 last year. It's around 3,500, and may have a potential upside up to 4,000, depending on a few things. First, about the price increase, how much we get that, and whether we continue to increase the retail sales price. Secondly, it depends on the recovery of international sales. The more quicker the international market begin to recover, the more quicker we can solve the shipping problems, then of course we are going to have more. Thirdly, it also depends on the sharing business, because one of the key contribution for our high ASP coming from the battery pack sales to sharing operators. If the adoption rate of sharing vehicles in overseas market become higher and higher, then the sharing operator will continue to purchase the battery pack. I think this is the three key drivers for the potential from 3,500 to moving towards the 4,000 RMB in the future quarters.
Okay, get it. Thank you.
We have our next question. This is coming from Bin Wang from Credit Suisse. Please go ahead.
Thank you. My first one is about sales momentum in April and the first 2 weeks of May, because you actually give some color about F series in April. So that's why I just want you can share about sales momentum in the past 1.5 months. That's number one. And number two is about the margin. You actually give the guidance for second quarter. I just want to confirm it's about 20% to 23% in the second quarter, and the second half will be 22% to 23%. Assume this is the gross margin guidance. What will be the net margin likely? Because in the first quarter we got a similar or even higher gross margin by 0 in the bottom line. So what should we expect in the bottom line net margin? Should be around 5 to 6%. Thank you.
Sure. I think for the first question about the sales momentum, I think our sales continue to be very strong in April. I think our sales growth was more than 60%, close to 7% growth in April, and that was still with a backlog of quite a lot of F0 models where we were not able to deliver in April, and then we continue to deliver some of the pre-sales orders in May. So in short, we do see quite a good momentum into the second quarter. That's why when we give the revenue guidance, we gave a 40% to 60%. It's relatively wide guidance, mainly because there's so many uncertainty about the delivery shortage, etc., etc. So in general, we do see continued strong sales momentum. In terms of gross margin, I think you are right. I mean, the second quarter we are looking to achieve anywhere between 20 to 22%, and in the remaining 2 quarters we target anywhere between 20 to 23%. So on annual basis, it's likely we end up somewhere around 22%. So that's how we see the gross margin potential. Of course, there are so many moving parts, as mentioned earlier. There's commodity price increase. There's so much fluctuation. It makes things complicated. Also, there are so many things coming from our international market. The international market has a significant impact on our gross margin, but our target is to maintain that, and we have price increase tools in our hand. We can manage that. There's also quite a few other things like launching new KQI e-bikes to help with that. So that's answer for your second question.
Actually, you all talk about the gross margin, right? Because in the first quarter you have a pretty decent gross margin, but you actually have a 0 in the bottom line. So my question is about the bottom line. So maybe, okay.
Yeah, I think in terms of bottom line, I think after gross margin, what will be next is the operating expense as percentage of revenue. So you need to deduct the operating expense. The operating expense as percentage of revenue will in Q2, Q3, Q4 will be similar to what we achieved last year. So Q1 is kind of a special case because we spent quite a lot in the sales marketing. But if you look at the R&D, the G&A, they are very reasonable amounts. The G&A is slightly higher in Q1 because we have around 5 million coming from foreign exchange loss. But throughout the remaining of the year, they won't see that much. Only the sales marketing was a little bit high in Q1 because of this Chinese New Year event. In the remaining quarter, last year, in average, our operating expense as percent of revenue was around 15%. So 14 to 15% is something we can think about. So after you deduct that 14%, 15% from the 22%, you got like 7% before tax, 7 to 8% before tax.
I think being basically the Q1 is the odd quarter because traditionally Q1 has always been a low sales quarter. If you look at our, the sales has a seasonality. But this year in Q1, we did spend spend quite a bit in marketing because to kick off the Chinese New Year, really try to make sure this year start with a high note. That's why we kick off the Year of Ox to be newer thing, and coupled with the lower sales season in Q1. By lower, I mean with respect to the 4 quarters within the entire year. That's why in Q1 you see a huge marketing expense. But if we spread over the entire year, the average marketing expense actually will be fall in line with what happened last year.
Great. Thank you.
Thank you. We have our next question. This is coming from Alice Ma. Please go ahead.
Hi, management team. Thanks for taking my question. I have 2 questions here. The first one is, could you please remind us of the OTA function? Like how many times have you done OTA for the previous intellectual scooters? And I saw that you have improved some of the intellectual properties of these characteristics of your new products in the new products launched in April. And could you how do you view that the consumers are viewing such intellectual characteristics? And my second question is about the batteries you use for different segmentation of your products. Like for the lower tier products, do you still use like the NCM or LFP battery, or what kind of battery will you use in the future? Could you please give us some guidance? Thank you.
So I think great questions. First of all, on the OTA, typically we do an OTA update every quarter or so, every 2 or 3 months or so. I think it's really just the OTA to upgrade the ECU, the software in the ECU, as well as some of the softwares in the motor controllers. So now, as I mentioned in the call, some additional smart functionality like a color display with the navigation mirror of your phone, that actually require not just the OTA software upgrade, it actually also require hardware upgrade. So that's why we actually build the hardware upgrade into the new model as well as the existing models. And along with the upgrade, we manage also to increase the product price that allow us to actually to increase the ASP to offset so that the downward pressure on the price due to the product mix. And so far, I mean, based on some of the upgrade product like the M2S hasn't really come to the market yet. It will be in the market in May. The UQI upgrade will also be in the market in May. So we haven't really seen the actual user feedback from those upgrades yet. But based on the user comments from our product launch, as well as the user comments from our social medias, basically the users are actually asking for those upgrades. Even we have users with existing MQI2 product asking whether their current product can be upgraded by paying. They're willing to pay more than 1,000 RMB just to get the upgrade on the color display and all the smart functionalities. So I think we expect those upgrades to be welcomed by the users. Now, the second one, the battery solutions, I think you're absolutely right. So basically, for the higher end products, like the N series and M series, we tend to use more the NCA and NCM batteries, the lithium-ion battery, NCA, NCM, due to the higher battery densities, such that we actually can put more battery capacities in the scooter to give the scooter a longer drive range. But we also recognize the cost of NCA and NCM is a bit higher than the LFP batteries. So for majority of GOVA series, the GOVA F, the GOVA G, and the potential the GOVA C series, we use the LFP batteries, where actually will help to reduce the cost, such that we can price at a relatively lower price to our users while maintaining a similar margin as our higher end price product. Now, what's what sacrifice of the compromise we took is with the LFP batteries, we are not able to put a lot of battery capacity into those batteries because the weight constraint of 55 kilos of the entire scooter. So what the user will compromise is actually on the drive range. So on those ones, we try to compensate that with the upgraded the V technology motors and also the improve the tires such that, for example, the low resistant tires will give a slightly bump up on the drive range. But I think that's practically how we line up the battery solutions in order to offer a wide range of pricing product to our users at the same time maintain a healthy margin.
Okay, thank you. A little catch up on the previous question. So you will for sure not using the acid lead battery in the future, right? And also, since I also heard some comments from the end users that normally the scooters from Niu are having a more accurate, the battery management system comparing with the other products in the market, you could have a better accurate how much the SOC of the battery. So when you use the LFP battery, can you also reach such accuracy in the future?
Yeah, I think that's a great technical question. So when we first adopt using the LFP batteries, we actually realized that without using a better SOC solution, then the reading of the battery capacity is not as accurate as the NCM batteries. So we start exploring with the LFP batteries last year. So we quickly actually improved the SOC within the LFP battery pack, as well as basically the battery management system, as well as the SOCs in the controllers, so that actually to improve the battery reading capacity accuracies. So our accuracy is 20% higher than what used to be in the market, and that actually will get us almost on par with the NCM or NCA batteries.
Okay, very clear. Thank you.
Once again, ladies and gentlemen, it is star one to ask a question. Seeing no further questions, I would like to hand the conference back to our host. Please take over, sir.
Thank you, operator, and thank you all for participating in today's call and for your support. We appreciate your interest and look forward to reporting to you again next quarter on our progress.
Thank you. Ladies and gentlemen, that concludes our conference call for today. Thank you all for your participation. You may disconnect now.